Okay, welcome back, everyone. My name is Ryan McMahon. I am an executive director for JP Morgan Private Bank here in Salt Lake City. It's my distinct pleasure to introduce our next speaker, Monica DiCenso, who has all-star status at this annual Entrepreneur and Investor Summit. For all of those of the serial attendees to this summit, you know her well, and she's backed by popular demand. A little bit of background on Monica. Monica is a managing director and the head of the Global Investment Opportunities Group, or GIO Group, at JP Morgan Private Bank in New York City. Prior to joining GIO in 2015, Monica was the head of U.S. equity strategy at JP Morgan Global Wealth Management, where she managed a team of strategists. Monica joined the private bank in 2012. With over 20 years of analyzing financial markets, Monica has been featured on CNBC, Bloomberg, and other televised business programs, and in various newspapers and trade publications. But nothing more prestigious than this summit. Today, we welcome Monica back to share her views on the market, investment, and emerging trends. And with that, I will welcome Monica to the stage. Everyone give it a hand.
All right. Thank you, Ryan. So I made slides because Kelvin asked me to. And then they were completely irrelevant after what happened in the last week. So we made them again. And I'm going to spend a little bit of time talking about markets, what's going on, but I do want to leave a fair amount of time for questions because I know much of what I've been doing the last week with people that I work with is answering questions. What does this mean? What does this mean for banks? What does it mean for investments? What does it mean for companies that are trying to raise capital and need capital to keep going over the next few years? So just a quick reminder, Ryan spoke a little bit about what I do. I run a team of about 50 traders, investment specialists in New York. We work with family offices, hedge funds, individual investors. We work with many public company CEOs, sometimes giving advice for their companies, sometimes giving advice to them personally on their investments. And I've been doing it for a long time, but I'm pretty comfortable saying that what we're seeing happen in markets this week is definitely one of the more unique market environments I've seen over the last 20 years. And I had the distinct pleasure of working at Bear Stearns. I think you all know how that ended. The question I've been getting most this week is this 2008 all over again? And I'm going to talk about some of what happened the last week at the end. I did want to start with just our views on markets overall, and then again, I'll leave a fair amount of time for questions. This slide here at the beginning, I see the title says See the Potential, and you might be thinking, wow, how can I be optimistic when everything feels so terrible right now? And the reason is pretty simple. In times of turmoil like this, it is often the best time to make an investment and or stay invested. And the last time I was actually here in person was 3 years ago, right before COVID. And somebody, I don't know if he's here, I didn't catch his name, grabbed me after I spoke, and he said, you know, this is going to get really bad. You're going to go back to New York, and everything's probably going to be shut down. And then I think he saw how horrified I was. And then he said, but don't worry, you'll be fine, you'll pull through. And so all during COVID, when New York was in fact shut down shortly after I left here, and we were all stuck at home, I kept telling people I met this very smart guy at a biotech conference, and he told me I'd be fine. So I leaned on that a lot. I don't know if you're in the audience. If you are, hopefully I can talk to you after, because you made us all feel a lot more calm through it. But if you rewind 3 years, I don't know if anyone remembers where the S&P was when I was here 3 years ago. It was right around 2950. So we went through a global pandemic, the entire world being shut down for like 6+ months. And if you had just stayed invested in equities, you would have annualized returns over 10% each year, over 30% to today. And so that's why I'm taking slightly more of an optimistic stance here, because history tells me time and again, times of crisis like this are actually when the best opportunities present themselves. And that's whether you're sitting in cash looking for something to do, or you should feel comfortable staying invested with your plan, because if you had just sat there and closed your eyes and hung out with your family during the pandemic and did nothing to your equity portfolio, you outperformed most managers during the same time period. So a few things I just want to hit on this slide, and then I'll jump ahead to some of the others. Bad news is good news, as we need to separate sometimes the market and investments from the economy. And I'll talk about this a little bit later. But in every time we've seen economic turmoil, the market, especially equities, bottoms before the economic data gets better. So while you're worried about the Fed or wondering what's going to happen and waiting to see jobless claims, unemployment, all that move, rest assured that the equity market in most cases is going to price this in well before it happens. We think that's happened already. And while we're seeing volatility in the last week or so with this bank crisis, I'm not sure we're actually going to retest some of the lows that we saw last year. And so that's one of the reasons we want to stay invested. That ties into the second point here, which is this is the best time in over a decade if you do have cash or you're looking for an investment to put money to work, because we have seen a pretty significant correction from recent highs. We have a slide talking about that later. And then the third point I want to highlight on this slide, bonds are back. For the last 10 years, you did not get paid to take risk in fixed income or to buy bonds. And I'm going to talk about why that flowed into what happened with Silicon Valley Bank and some of these other banks, because what it did is it pushed people to take risks that maybe they shouldn't take or weren't comfortable taking. It also results in a lot of market participants sitting on one asset class, and when things get a little scary, they run out of that asset class and they go somewhere else. Now, for the first time in a decade, you have the opportunity as an investor to invest in equities and stocks and to invest in bonds and to get paid for it sometimes better than we think you're going to get paid in equities. That's a big deal because if anyone studied finance, bonds are higher in the capital structure. So if I could be higher in the capital structure versus equities, why would I not want to be there if I can get paid the same? And that opportunity is there now. I know there's a lot of charts here. I'm not going to be able to walk through all of them because I don't have 2 hours. But I wanted to hit on some of the questions that I get and some of the data and how I get comfortable. So when I look at this slide, we talk about housing. And I put this in here because everyone says, okay, isn't this 2008 again? And this is one of the slides that I highlight when I say, no, it's not. Because in 2008, you did have a housing crisis. And we are having weakness in housing because of what the Fed has done. But it's very different from people being over-levered and housing values plummeting to what's happening now, which are, we actually don't have enough housing for most people in the US. There's a housing shortage. But what's happened is because rates are higher and there's a housing shortage that makes it more expensive to buy a new house, people aren't moving. Because why would I sell my house at my low rate, my low mortgage, and reprice myself at a higher rate? And so what's happening is what the Fed is doing, it is slowing down housing, but it's a very different kind of housing cycle. Some of the outcomes may be similar, but it's different in that it matters more for us as market participants, that it's less of a housing crisis and more of just what I view as a normal housing cycle and a normal up and down that happens. The other thing I would highlight on the bottom of this slide, the two charts on the left and the right, are focused on the health of the consumer. You've heard a lot about layoffs the last few months. Banks, my industry has laid off a lot in New York. A lot of tech companies have been laying people off. And yet the labor market, that lower left slide, you can see how strong it is versus history. We're nowhere near the layoffs that we saw during COVID. And in fact, the labor market's still very tight. So what does that mean? While you're seeing layoffs more on the higher end and higher income side of the population, lower income people in the US are actually not getting laid off. And the labor market's very tight. That's important because it flows to the lower right-hand side here. The lower-end consumer in the US, they spend most of what they make. So as long as they have jobs, they're spending. They do have jobs, they're not being laid off, they're spending. These layoffs are hitting higher income participants in the market. They tend to save more, they don't spend as much. And so as a result, you're having a weak labor market in some pockets, but it's not flowing through to weaker consumer spending. And that's one of the reasons that we're actually still remain relatively optimistic on the US economy, in spite of, again, what the Fed has done to try to slow things down. The other question I get whenever I talk about things like the market might actually be okay is people say to me, well, hold on, what about the Fed? What about inflation? This is going to be the 70s all over again. And we have a number of charts here that talk about why we actually think what the Fed has done with raising rates has actually made inflation come down a little bit. And I can tell you in my day-to-day life, I live in New York City, nothing is cheaper, or nothing feels cheaper. But when we look across the bulk of the US, in a number of important categories, goods, that's things that you buy, are down from where they peaked over the last few months. A big one is energy prices, down meaningfully. So again, I don't drive in New York, but I hear people do own cars, and they have to put gas in them, and gas prices are down by half at the pump. So that is a huge benefit, again, not so much to people at the higher end of the US economy, but certainly, again, mid to lower end US economic participant, they benefit a lot from lower gas prices. It makes their monthly bills significantly cheaper. And the last one, the lower left there, rent. So after COVID, you saw very low rents because people were trying to get the people back into apartment buildings. Then they quickly raised the rent once they could. Well, now those leases are rolling over. And so you're seeing rent prices finally stabilize back to a normal level. So when you add it all up, all the major metrics that we look at that actually go into how you think about inflation and what makes that number higher or lower are finally starting to come down. And so the chart in the lower right there shows you, okay, obviously inflation is still elevated from where it's been historically and where we were over the last 10 years, but we believe it has certainly peaked and is on the way back down. Now, this matters because it means what the Fed is doing is working. But to me, the fact that it's still elevated ties into what I'll get on in a moment, which is I think the Fed is still going to raise rates. And that has implications for all of us, not just as investors, but you're running companies, you're thinking about how to invest capital. A world where rates are still higher for a little bit longer has some pretty important implications. And we're likely going to be in an environment, I believe, of higher rates for a little bit longer than people expect. And this is exactly what I was getting at. These two charts show just what the market is expecting the Fed to do. And if you look at the chart on the left, these are rates across both the US Fed funds rate. You also have Bank of England there, Bank of Japan, as well as the European Central Bank. And you can see across everywhere in the world, rates crept up into the teens. During COVID, everyone basically went to zero or below zero, and now everybody is raising again. And the question now the market keeps asking is, how much further will the Fed go? About 2 weeks ago, before the happenings of last week, people assumed that the Fed was actually going to start cutting and there would be no more hikes. And you can see that chart, the dotted line is showing how the market's assuming things start to roll over. Then obviously we had the crisis of last week and people said, well, gosh, they absolutely can't keep hiking. And that caused a lot of nerves. And part of the reason the market was so soft is people said, well, hold on, we're having a crisis, but the Fed hasn't done its job of actually getting inflation in check. And if they can't hike anymore, what does that mean? Just this morning, the European Central Bank hiked 50 basis points. And they said, you know what, they're having a crisis of their own with obviously Credit Suisse and some banks in Europe. And in the face of that, they said, we're going to backstop our banking system. We don't think this is a systemic issue. And we are focused on making sure that inflation comes down from where it is. And so I think that's probably a hint as to what you'll see from the Fed next week. And to me, is a good sign because I think if the Fed had reacted and completely backed off their inflation mandate going into next week because of what happened last week, it would have been very confusing for the market. Because on one hand, you have the Fed saying, don't worry, we've got all of you who invested in Silicon Valley and Signature, we're going to take care of you. This isn't a systemic issue. But then if they back off their plan of what they've been doing the last few years, that sends a mixed message. That's the reason I don't think they're going to back off. And we'll talk about what that means for markets or investments in a second. Now I'll get to the optimistic part, a little optimistic. So where we've been looking, I'll talk a little bit about the US and some sectors we like. I do want to mention Europe and China, though, as well, because I believe this is a global audience, but people tend to invest. We all have a home country bias, invest where we tend to live. We feel more comfortable there. Europe has been fairly uninvestable the last few years because everyone's been very worried about, obviously, the crisis with Russia and Ukraine, and what does that mean for energy prices, and how can you invest in an economy where there's a war going on. We actually remain fairly constructive on Europe, and I'll talk about the pockets that we think are more interesting. But overall, that chart on the left is showing you that economic data in Europe has actually been pretty good. And so the most consensus call from people like me last year, although I didn't say it, was that Europe will be in a recession in 2023. It seems quite clear that Europe is not going to be in a recession in 2023. And so I'll talk about why there's some opportunities there. Part of the reason Europe is not in a recession is what's happening on the right-hand side, which is China. So while the Fed is trying to tighten and slow things down here in the US, you have China doing the exact opposite, stimulating, trying to get people to spend, encouraging them to travel by opening up the market. What does that do? It means they're traveling, they're going on vacation, they're spending money. So you've seen a big pickup in demand for luxury brands, consumer discretionary companies, travel companies. It also has implications for energy and anyone who's like travel adjacent, airlines and things like that. So when this happens, because everyone says that the big bear case in the market is a global recession, you don't have a recession right now in Europe and you don't have one in China. And so to me, that chips away at that very negative view that a lot of people have on the overall global market. And then I do want to talk for a moment. I'm sorry, this slide has a lot of bars. This goes back to a point I made at the beginning. and why times of crisis are often some of the most interesting times to invest. And what we have here going across this page are every kind of asset class that you could invest in. There's cash, there's fixed income, bonds, there's equities, and there's alternatives. In the alternatives bucket, we put hedge funds, private equity, and real estate. And what the two bars are, the bar in each one, the lighter colored, is what we expected the return to be over the next 10 years if you invested in that asset class in 2022. And these are what we call our long-term market assumptions. The bar in each category on the right-hand side is what we expect your return to be if you were to invest today. So what this is saying is, in every single category, every asset class that we have the option to invest in, we think the opportunity today is more interesting than it was a year ago. Now, that's obviously partly because many of these asset classes have seen a correction, right? So you're getting in at a lower level than you might have been a year ago in some cases. But it also tells the story that I believe the market is looking at right now, which is we are nearing the end of a cycle, probably at the end, and you're going to have a recession in the coming months if we're not in one already. But you don't wait for that to happen to put money to work for the next cycle. The most important time, again, to get in is now, when asset prices have sold off. And so really anything on this page is going to offer you better returns today than a year ago. The one exception is US real estate, and I'll hit on that and maybe I'll get a question there. We are seeing some weakness in commercial real estate, so think office, stuff like that. Commercial real estate is not a big part of the U.S. economy, but obviously it matters if you run a commercial real estate business or if you're renting to companies, things like that. And we're not seeing weakness everywhere. Part of it is driven by, obviously, will people go back to work everywhere? What we're seeing is people are willing to go back to work for the right kind of offices, newer office space, more collaborative office space, where they don't want to go back to work. And I see a lot of them near where I work in Midtown New York, are some of those old buildings that are kind of like stale and not very fun and not collaborative. I think it's hard to convince someone, if you're going to sit alone in your office all day, that you need to do it in Midtown Manhattan versus doing it at your apartment. Whereas if you're collaborating with a group of people like we do on a trading desk where everyone's sitting together, there's a lot more camaraderie. And so, a lot going on here, but this is one of, to me, the most obvious calls to action that, like, no matter where you look and where your comfort level is in the investment spectrum, there is something more interesting to do now than there was a year ago. And I wasn't here a year ago, actually. My colleague Jake was, so hopefully he didn't tell you all to put all your money to work a year ago. So now I'll just jump into a couple of the distinct investment opportunities I think are worth a look. I mentioned bonds are back. This slide, all about bonds, all about fixed income. Same idea as we showed before. So what kind of return we would expect across different parts of fixed income, where we were back in 2021 versus where we are now. And this is focused on yield. So where can I, as an investor, higher in the capital structure, earn a little more income for my risk? And again, no matter where you are, you're earning more. Now that's because the Fed has hiked, obviously, since where we were 2 years ago. But it's also, again, this recalibration of markets. I'm not suggesting that you chase the highest yield. That would be high yield. Those can be often riskier companies with less strong balance sheets. But one area that stands out to me, and I'm a trader, so I got to put that out there, that is what I do all day, is preferreds. If you've been following what's gone on in the last week, it is not great for banks. Most preferreds in the market are issued by banks, and so rightly, they have traded very poorly. They should trade poorly. We have had banks go under. But when there's a crisis like this in one sector, like what's happening now in banking, everything takes a beating. And so there is an opportunity to look and sift through that carnage and try to find interesting opportunities. And I have a slide at the end where we'll talk about the difference between some of the less capitalized banks for some of the ones that are better. And you're still seeing a dislocation across the entire sector, so there are opportunities there. I also would highlight here, if you look at the yields you're earning across most of this world in fixed income, call it 5 to 7%. And by the way, this is all pre-tax, so if you're a US taxpayer, some of it is actually better. We expect equities to return annualized 6% or so a year over the next few years. So again, you can buy probably what is a higher quality asset and get almost the same return. To me, that feels like a no-brainer. Most people I work with had very little allocations to bonds last 10 years because it didn't pay. And now you're seeing a pretty significant rotation to finally start getting back into this asset class, which historically, if you've heard the term 60-40, has been almost half of people's investment portfolios. And it really has declined meaningfully in the last few years. Then I think the other thing that's important to highlight, because I talked about going through a cycle, and the last cycle's ending, we think a new one's beginning, And a mistake that I often see people make is, I made the argument that you want to stay invested, and that was like a diversified kind of investment, like the S&P or diversified equities. But the mistake I see people own single equities or sectors is they tend to hold on to what worked before and assume that that's going to work in the next phase. And this last phase of the equity market was driven meaningfully by tech, and large cap tech at that, and that they were a big beneficiary of low rates. Because if interest rates are low, I don't mind giving you, big tech company, my money, because I'm not giving up that much by giving you that money for the hope of making more in 10 years. Now, all of a sudden, if I can get paid 5 or 6 or 7% in a bond, I'm not sure I'm willing to give a big tech company the same money I would, or the same latitude, and wait for that return over the next 10 years. And so we believe what's going to happen is you're going to see a bit of a rotation out of some large cap, especially in tech, and into smaller and mid cap companies. And that's great if you're in, healthcare industry, small mid cap tech. A lot of US focused consumer companies are small and mid cap. This chart on the left hand side, it's hard to find data that is this consistent. Every single recession that we went back to the 80s, small and mid cap underperform into it, and then coming out of it outperform meaningfully. Now again, timing this stuff is hard, but we work with a number of managers that take more of a small mid-cap tilt. This is the time, from a cycle standpoint, where you generally get paid to take risk with small and mid-cap companies. On the right-hand side, Europe, I mentioned it earlier. I spoke a bit anecdotally. I want to show the numbers because if anyone in here is invested in Europe, you're probably thinking, Monica, you're crazy. People have been talking about Europe forever. It's always a disaster. They always disappoint. They always break my heart. And I will say I've myself lost a fair amount of money trading Europe over the past. But why I think this is different right now, this chart on the right shows the valuation disparity between the US and Europe. And again, in COVID, I understood why most clients I work with said, if I'm going to go back in the market, I want to go with the US. I get it. I know what we're doing on COVID, how we're reopening. I'm not clear what's happening in Europe. Well, right now, the significant valuation gap, you can buy European companies that are very similar to their US counterparts that are trading 30% cheaper. I'll give you an example. Diversified energy company. I'm not advocating for energy companies, but I'm just saying as an investor, you can buy a diversified energy company like Shell trading 30% cheaper than their US counterparts just because of where their zip code is. There's some other nuances, obviously I'm simplifying, but 30% discount to me is interesting and starts to show where there are dislocations because people just say, I don't want to invest in Europe. European energy companies also have been burdened by the fact that many of their investors in Europe don't want to invest there because of ESG mandates. As big energy companies have started to wake up more to ESG reality, they're all investing a lot. And so those mandates are shifting and people are actually able to start investing there. So I think Europe is not only interesting anecdotally, but the numbers you're actually getting paid and it's almost like it's on sale for the first time in the last 25 years. And then this chart is super busy, and I realize probably you can't see it, but this speaks to what we were trying to show here was the point that I was making about cycles and how, while I generally advocate staying invested through cycles, again, parts of the market, sectors very rarely does one company perform through multiple cycles. And what we found is over time, you see these shifts between tech and higher growth companies, and then what we're affectionately calling like the real economy. So think industrial, think parts of healthcare, think utilities, some parts of the financial market. And so again, this last big boom in equities was driven by the beneficiaries of low interest rates, again, most notably tech. As that's coming to an end, we think you want to be a little bit more diversified. I'm not saying stay away from tech. In fact, I think things like semiconductors and AI, there's a ton of interesting things you should be doing in tech, but it just doesn't mean you own the same 20 companies that you owned during the last part of the cycle. And so we have a lot more research on this that we can share with you all and dig in later time. I realize I could probably spend 20 minutes on just this slide alone. So it's not over. This is where it ended when I put the slides together 2 weeks ago, and then the world kind of imploded. I was actually in Iceland last week when this is all happening, which is a very cool place if you've been there, literally. And then I did not get much sleep because my phone was ringing off the hook for the last 7 days. Obviously, a very challenging market and a very challenging time, and I would say a scary time. I kind of jokingly mentioned at the beginning that I worked at Bear Stearns, and I ended up coming to JP Morgan through that merger, but I was out with my team this week having drinks, and it was weird how on Friday all this stuff happened, and the market kind of digested it okay. And when I took my team out for drinks to kind of try to help them feel okay, a few of the junior people came up to me and they said, it's crazy. That was so scary. I can't believe, a bank went under, but it's good to see that everything's okay now. And I want to remind anyone who wasn't following financial markets when Bear Stearns happened that yes, a bank went under, what was it, 15 years ago, this right now. And it wasn't until 6 months later that Lehman happened and other things happened. And I'm not saying that this is '08, and in fact, I don't believe it's '08, but I don't think we can assume that something as severe as multiple banks going into receivership and needing bailouts from the government can be behind us within a week. And so I wanted to put a couple of slides in here just to talk a little bit about what we saw, and I assume I may get some questions on this. I was going to leave a little bit extra time at the end just to talk about this, because I'm sure, I work with a lot with tech startups, people on the West Coast and individual investors on the West Coast, and it's rattled a lot of people, and it's been very scary, and we spent a lot of time trying to help people figure out their next steps. So hopefully I can be helpful here. A few thoughts on what happened, and quite frankly, why I don't think this is 2008 again. So we call this Bonds 101, prices move in an inverse way to rates. And so what happened when the Fed went through this meaningful hiking cycle, and that's what's the orange line there, what you can see is we just haven't lived through a hiking cycle this severe in our recent investment history. And so that's the reason, that sharp move from where we were in 2022 to where we are now, that caused a lot of this volatility. And what we're showing there in the bars are held to market securities. And so these are, if you look at the left-hand side, that's showing the unrealized losses. So as the orange line goes up and rates go up, which is the right axis, the left axis, your unrealized losses go up in your investments. And these are, again, held to maturity securities, what we're highlighting. So think about a 3-year government bond, a 5-year government bond. And the reason a lot of companies owned this is because you weren't getting paid to just own short-dated treasuries a few years ago because rates were so low. So people went out on the duration or maturity spectrum and said, okay, I need to earn something on my cash and my deposits, so I'm going to buy something that goes out 5, 6, 7 years. Fine, you're going to get a little more income. The problem is, if you have a mismatch between your investments, obviously, and your deposits, and then you have a mark-to-market loss, suddenly that can cause some panic. Now, I highlight this as different from '08 because to me, again, it's very different. What happened in '08 is you had investments that actually were bad investments. Investments in mortgage-backed securities, things like that, for homes that had vastly inflated values. They weren't worth what the balance sheets these companies said they were worth. These bonds are worth, I believe, if you hold them to maturity, what they say. I believe the government's going to pay you back in 5 years. The problem is between then and now, you have a mark-to-market difference because of what's happening in interest rates. So what the Fed did and the government did this last weekend was very important. They said, don't worry, we've got you. If you have any of these investments, just pledge them to us. We'll give you the cash right now because we're going to give you the cash now, we're going to give it to you in a few years, and we'll make sure that you can meet your deposit needs. So they've stepped in to stop this risk from continuing to ripple through the market. But I think this point is really important and sometimes gets glossed over, that this is to me why it's different from '08, because you're not talking about what I would call a little bit scary and significantly riskier bets that have gone downhill. The one question I get when I talk about this is people said, okay, but are you saying that all the investments these banks made are good? That we don't know. Did they make loans to companies that can't repay them? I'm sure they did. But the vast majority of what caused this crunch were these relatively safe, if you can wait until maturity investments. And so that's why I believe there's a pretty big difference between what happened 15 years ago and what's happening now. A couple more slides on this, and then we can jump into questions or really whatever people want to talk about. A couple more things just on this issue. What you can see here on the left, this is deposit growth at some of these banks. I mean, I'm not saying anything that many of you probably don't know. Obviously, some of these banks, like Silicon Valley, benefited from the boom in tech, and that totally makes sense. As they had more deposits, the bank grew. The tech market benefited the last 10 years, and so it makes sense that people put more of their cash in the bank that they had banked with. But this goes to why this may not be a broad systemic bank issue across the whole country. Broadly speaking, you actually haven't seen deposits at most banks go up that significantly. And so what you saw at Silicon Valley and Signature, who had a lot of exposure to crypto and kind of more tech companies, was they were beneficiaries of what was going on in the overall market, more so than the broad US economy. And so when you're talking again about banks and the whole sectors, getting hit on what's been happening, you do need to start to differentiate that not all banks are created equal. And I'm not talking about JP Morgan here. I'm just talking about some of the larger, more diversified banks versus some smaller ones. And then this one, I apologize, there's a ton here. And again, I can send this out to anyone who would like to dig into it a little bit more. What we tried to do, because we kept getting the question, like, okay, Signature Silicon Valley, we get what happened there, but where else is there risk? And we were getting inundated with calls from our clients who bank with a lot of other regional banks, like a Zions, like a Capital One, PNC, et cetera. And so our teams have spent a lot of time trying to put together some ways to think about the risks at these different banks. On the left-hand side here, this is the uninsured share of deposits. So if you think about the bank overall, you can see some of the banks that obviously had the most issues did have a large amount of deposits that were uninsured. That means they were over the $250,000 limit. I think this chart is probably a little less relevant because, again, the Fed has come out and the government has come out and said, we've got you. Like, we're not going to let depositors who had above that amount not get their money back. And then you're not going to get it back right away. And that's obviously a problem for a lot of companies and people who need money day to day. But you can see there's a very distinct difference between those two banks way on the left. No shock that First Republic is next. That stock continues to be under a lot of pressure as everyone wonders, could they be the next one to fall? I'll give you my opinion. I don't think the government wants another bank in receivership. And so there were a lot of headlines over the last 24 hours or so that a number of banks, including mine, and again, I know nothing about that, are looking at a potential partnership or support of First Republic. And so I don't know if anything happened while I've been on stage, but I think you're going to hear something over that in the next couple hours. I think the government is doing whatever they can to try to make sure that the two receiverships that happened of Signature and Silicon Valley are the only two that happened in the US. The chart on the right, this is a little bit wonky, and I apologize, but if you want to dig into the numbers, like the big thing that people look at when they look at stress tests for banks are capital ratios. So how well capitalized are you? How well can you stand stress if the market turns over? And historically, because they were considered systemically important to the economy, the big banks, the big money centers, JP Morgan, Wells, Bank of America, they all had to have higher capital ratios. And I think you all know the story now. The smaller regional banks, which were considered not systemically important, didn't have to have as high ratios. So they could have a little more risk in their balance sheet. What we did is we looked at, okay, what's the blue dots, or what are their capital ratios just based on the normal metric you'd look at them, which is called Tier 1 capital. The orange dot there is saying, well, what if you adjust for what just happened at Silicon Valley, these unrealized losses that a lot of these banks are sitting on because they bought longer dated bonds. And you can see every single bank did this. So we're certainly not saying like Silicon Valley did anything wrong. Everyone was doing the same thing. But the extent to their issues, if you take their normal capital ratio versus the unrealized losses, obviously was most severe at Silicon Valley. When you look at some of the other well-diversified banks, and I take a Wells Fargo, for example, like, yeah, it's a little bit lower than their Tier 1 ratio, but still in a very healthy category. And so this is some data that we use, and we, again, talk with clients who are saying, I'm nervous. Again, I bank with PNC. Should I be that nervous? Yeah, their capital ratio is still in an okay spot. What I think this does tell me, though, when I talked about there could be opportunities investing here, if you're going to make an investment or keep your money with a bank that's more towards the right-hand side of that chart, I would just expect a higher interest rate or a better return on my investment, right? It doesn't mean you shouldn't do it. It just means that you should get compensated for that risk because there is more risk inherent in the investment. So I believe this is my last slide for real. Yes, it is. Now here's the disclaimers that say that, well, they say all sorts of stuff, so I'll ignore them. I do want to end just with a few concluding points. I know we walked through like a ton of information, a ton of slides, a ton of charts. I don't want to come across as glib. This market, it's a bit scary. For many people, it's unprecedented. I'll leave you with one stat. 80% of money managers today in the US have been doing it for 10 years or less. That means they have not invested through a serious recession. They made it through COVID, but they have not seen, again, the likes of the financial crisis or what happened in the 90s or anything like that. What does that mean? It doesn't mean you should be scared of money managers. It just means we will see more market volatility because you have participants in the market who have not been through this before and maybe don't have the same stomach to handle it or the same risk parameters in place to handle it. And so that just means I expect going forward, you're going to see more volatility. That doesn't mean you shouldn't be invested. And in fact, with volatility creates a lot of opportunities. And I am more excited today to put money to work than I was over the last couple years because you're not seeing all this froth in valuations as you did a couple years ago. And so I stand here actually pretty optimistic, even though I acknowledge the next couple months, I have no idea what next week is going to bring or 2 weeks from now. But we are here to help. As I mentioned, I spent the weekend talking to everyone I know on my client side. And so I would encourage anyone who has investments or you're thinking about your company or portfolios, like whether it's myself or whoever your banker and advisor is, like this is what we do, and we're all here to help you all get through this. But I would just say stay calm, don't be scared. I'm actually pretty excited on what's to come. I will pause now. I think it's a few minutes. Questions, thoughts? Anyone disagree? Happy to take anything. I think I see someone, but I can't really see with the lights, so I'll trust the people with the mics.
Thanks, Monica, the great presentation. I wondered if you could speak to what really is going to happen to Silicon Valley Bank and Signature Bank. How are they going to get? They're now being called a bridge bank, and they're looking for somebody to buy them. What's that process look like? Since you went through it at Bear Stearns.
Yeah, what's frustrating is as time goes on, it just gets really scary, right? I went through it at Bear Stearns. It happened with us over 5 days, and I remember at the time I shouldn't say this, but it was actually kind of funny. My boss and she said, all right, we're going to sell our business to another bank. So we stole all of our computers and files and ran out of the building and set up shop in her apartment. And then in the end, JP Morgan hired us. They made us bring all the stuff back. But I expect that's probably not what's happening there because this is a different situation. I think the best analogy is Washington Mutual. So JP Morgan bought Washington Mutual because we wanted the footprint of that bank. And so it had something that was interesting to the buyer. And so I think what we're hoping the best case scenario would be with Signature or Silicon Valley is you have banks with very loyal client bases, very deep tentacles into certain parts of the market. So if I was a large bank who didn't have much exposure to tech or that part of the world, that would be really interesting to me. So I think the best case scenario is you have a mid-sized bank who wants to be in that part of the market come in. Everyone's been asking me, is JP Morgan going to buy them? Again, I literally know nothing. I'm just guessing as a market watcher. I'd be surprised because I know we have a big footprint out there already, so I wouldn't think you'd see a JP Morgan or a Citi come in, but I think you could see one of the smaller banks come in. And I think the government has been pretty clear, like they want to make something happen. They don't want these things to just languish and this to perpetuate for too much longer. So I would guess over the course of the next few weeks, you're going to see either parts of the business sold, the assets sold, or something just gets swallowed up by one of the larger banks. It's a little bit tricky because some of the ones in the middle part of that right-hand slide there, they don't actually have enough capital and bandwidth to do it. So you're kind of stuck thinking, like would a Bank of America, maybe a Wells, maybe. Those would be some of the ones I think maybe could, but or you're breaking up them into smaller pieces. So I would highlight as an equity holder, I don't think you're getting anything back if you owned the stock. If you follow, Silicon Valley does have bank preferred, so that's one step up in the capital structure. They were trading like 5 cents on the dollar a few days ago. They're up to 15 cents on the dollar. Now, that's still pretty bad, but something is going on there, or people are betting that you're going to get some recovery value in those assets. And so in a situation where they get sold, you could see that going to 30, 40 cents on the dollar. So I think there's some potential there. This is going to be a very fluid situation, I would say, for probably the next 2 weeks. I can't see if there's other questions, but feel free to shout if anyone else has anything. Yeah, he asked about Credit Suisse. So, was it just Credit Suisse and what we think? So, messier, because you're talking about one of the reasons Silicon Valley and Signature are bad, but didn't cause what happened with Bear Stearns and Lehman is because of how much they're integrated with the financial markets, right? So it hurts, obviously, all of us who had money there and small companies. It's devastating. But it doesn't have what we call counterparty risk because of like derivatives, investment, stuff like that. Credit Suisse has that. So that's why on Wednesday, when this all started to bubble up with Credit Suisse, which we've known they've been going through restructuring for a while, but things got really bad when the Saudis came out, I guess it was yesterday morning, and said, we're not going to put any more money in. By the way, the Saudis have since tried to walk that back and say, that's not what we meant, we were misquoted, we just can't put any more in, but we think they're a great bank. So take that at whatever. What happened last night, though, the Swiss government came out and said, we're there. We're not going to let you go under. which basically says you are systemically important to either Switzerland or to Europe. So the problem is there's not that many other Swiss banks. So right now they're backstopping whatever capital they need and making sure they have the liquidity they need. But this is a bank that's had just many, many issues and has internal control problems, stuff like that. So our best guess is, do you see them? It's hard to imagine UBS takes them over and they have this one giant bank in Switzerland, but I guess you could. There's also talks about Deutsche Bank potentially merging with them. But I think what was most notable for me that gave me a little bit of confidence this morning was Christine Lagarde's comments when the ECB raised 50 basis points. She said, we're doing this because we believe the steps that were taken to ensure that Credit Suisse remains a going concern will be enough. And she said she believes the banking sector in Europe is stable enough to withstand higher rates and to continue to exist as they are. Now, it'd be crazy if she said anything else, but I think the fact that she said that and that she raised rates tells you that she at least feels like there's enough of a plan in place to get Credit Suisse through whatever's going to happen over the next few months. Now, do I have clients who have investments with Credit Suisse that are very worried? Of course. Would we be recommending Credit Suisse stock to someone to trade it? No, just because it's just too risky. But I think what's been giving me a little hope is how quickly the Swiss government moved, how quickly the ECB has talked about this and implied that they're going to be there to make sure this doesn't get any worse. But I can tell you yesterday when I was talking to my people internally, they were saying it'll be gone by the weekend. I am not in New York today, but my guess is they have a different view right now, given what's happened. But again, I go back to one of my other comments, like this is not normal. So like when you have banks and people this worried, like this is not a good normal market, but it is one where there are things to do, if you can stomach it.
Monica, can you talk a little bit about what you think the volatility is going to look like over 2023?
Yeah, I think there'll be a lot of it. It's already one of the, I don't have the chart in here, I wish I did. One of the strangest things that happened in like 19 and 20 before COVID was incredibly low market volatility, the lowest levels we'd seen in 20 years. Obviously with COVID, that reversed pretty quickly, it calmed down again, it's now picking up again. Volatility is actually normal, so what you saw in 19 and 20 was actually abnormal. Volatility was low because rates were low and everything was euphoric. Normal volatility, I'd say we're like a standard deviation above that, so we are in an abnormal volatile environment. But again, that is what creates opportunities and creates dislocations. So when everyone gets scared about banks and every bank sells off, that creates an opportunity for you to say, this is the one that I feel comfortable with, I can take some risk. One knock-on effect of that volatility, capital markets. We started to see at the beginning of the year a few IPOs, a few follow-ons. In fact, one of the best IPOs of last year, the biggest IPO that happened was Porsche in Europe. At the time, I was talking with the company. I said, are you guys crazy for coming out in this market when it's so volatile and everyone's so worried? That stock IPO'd at 82 euros. It was at around 115 today. Amazing performance. Tells me that even in a volatile market, great companies can get capital and get investors and succeed. So I would say volatility is normal. I expect it to be higher, but that could be good for market participants. The downside is the capital market impact on IPOs and people being able to come public. I was starting to pick up, and I suspect it's going to be very quiet now because of what just happened with the banks for at least another month. So I'm now looking to like the back half of 23 to see capital markets pick up, which is frustrating because the other knock-on effect of what's happening with banks is it's going to be harder to get loans. And so as you know, I can tell you at JP Morgan, like everyone's just a little worried and we're hunkering down or being very conservative. So that can be challenging. If you can't tap public equity markets and loans are more expensive, that can be a little bit difficult. There's a lot of middle market players who are there providing capital. But I would say that's one of the things that a little bit concerns me and frustrates me because it will hamper growth in some sectors. Anyone got anything else? No, I think I see something. Or someone's waving at me. Or you can shout. I can hear okay. I just can't see you.
So I've heard it said that Silicon Valley Bank took 45 years to form it, and about 4.5 days to kill it.
Yeah.
And a big part of that, obviously, as you pointed out, but another part of that was just the venture capitalists and others running on the bank.
Yeah.
I think had that not happened, the bank could have raised some more money and probably got back on its feet. Are we doing enough to calm that? You know, you see, for instance, First Republic is mentioned in every article and such.
Yeah.
And that tends to make people nervous. Are we doing enough to get rid of that nervousness in the market?
So for those who couldn't hear, the question was Silicon Valley, 40 years to get to where it was, 4 days to unwind. It was unwound by a classic run on a bank, which probably could have been stopped with better communication and market participants not acting as erratically. And now you're seeing First Republic in every headline, and he was asking, are we doing enough to prevent this from happening again? Again, I want to be cautious because I work at a bank, and I am incredibly sympathetic to everyone at Silicon Valley because I agree with you. What happened should not have happened. Because again, they didn't have bad investments that weren't going to be money good at some point. They just had a mismatch of some of the timing, and then when the timing went through the roof because everyone panicked, it caused a classic bank run. What we didn't realize at the time, again, by having that concentrated client base, in one way they were super loyal, and the other way they all talked to each other. And so if you think of any traditional bank that's so well diversified, and I always kind of throw my parents into it, like my mom called me like yesterday to be like, should we do anything with our money like outside of Boston? I'm like, yeah, you're a week late. But the point is, like, if you were in Silicon Valley, like, it wasn't a week to get this information across. And one of the scary things about the way information flows just in general now, right, and why you didn't see this in the 80s and 90s is everything just happened so fast. And I'm going to be a little cynical, by the way. I used to work in media before I did this, so like I realized I was probably part of the problem. But what sells papers? What gets you watching the news? A little bit of a, I always joke in CNBC, there's always like the countdown to the debt ceiling, the countdown to this. Like it's that slightly emotional kind of behavior that I think can make these issues worse. I will say, and again, just trying to be objective, I'm not an expert in Silicon Valley. What's so unfortunate when you look back at it is I think the bad communication around their capital raise probably led to this too. Because when you need to raise money to raise capital, you just do the deal. You generally don't call up everyone and say, hey, I need money, I'm thinking about doing a deal, because that causes panic. So there was just they'll write books on this, and we'll all look back and say things should have been done differently. But I think the run on that bank and Signature was very specific because they're a very concentrated client base. Now, are we doing enough for First Republic? I think what the Fed has done is enough, because theoretically what they said is you don't need to take your money out of them because every other bank is going to support them. So if you take your money out of one bank and put it to someone else, you're just putting a tax on them. Now, I don't know that everyone in the market understands that. My mom certainly doesn't. So there's a lot more education to be done. I worry that we're still a little bit in the hysterical state where I don't think people know fully how to handle it, which is a little bit worrisome. And I would love to see a little more communication done to lay people in the economy, just to help them feel better that things are safe. I think people who do what I do all day kind of understand that I don't need to move my money from one bank to another because it's equally going to be fine whichever one I go with in the end, but I'm not sure that message is everywhere yet. So I think the Fed and the government they moved really quickly, and they went further than I would have thought they went Sunday night. So I think they did as much as they could do. Now it's kind of up to all of us, the media, to try to make sure that we calm people down. And I think if you can get to next week with First Republic kind of hanging in there, temperatures will be down a little bit, and we might be in a better spot.
Quick follow-up.
Yeah.
So in 2018, we changed some of the regulations
Yeah.
to take some of the smaller banks out of the regulatory environment. Do you think putting that back in would help?
So the question was about the 2018 regulations that were rolled back for small banks. And I was hearing a colleague talk about it today, and I thought the way he put it was perfect. Like, I don't want to say the regulations in 18 were a mistake, the rollback. And what the regulations were is they said, hey, we need to make sure that the systemically important banks that can take down all of us, like a JP Morgan or a Wells, are going to be there. So they have to do more. They have to be safer. They have to be accountable to all of us as taxpayers. We're not going to bail them out again. That 2018 rollback assumed that some of the smaller banks wouldn't cause what's been happening over the last week. That assumption clearly was wrong. So in 18, you had the government say these small and mid-sized banks are not systemically important to the US economy. What just happened last week showed us a couple of them together are systemically important to the US economy. So I have to expect you are going to see meaningful regulation coming, not just probably more to the big banks like us, but to the smaller and mid-sized ones. And that, by the way, is another reason why if you're an equity holder in some of these banks, these stocks should be down. And bank stocks should be down because this is expensive to follow. You have to hire a ton more lawyers and compliance people and people to stay on top of this stuff. The only question, though, is will the legislation get through? Because you obviously have a split government right now, so I don't know that you're going to get, well, given the public pressure, maybe you get consensus to do something. But my guess is you'll see more regulation come out in the coming 6 months. But most importantly, I think, unfortunately, we learned the hard way that any kind of bank rolling over or a couple rolling over like this is going to have knock-on effects all through the economy. Oh, I'm getting pulled off. I'm around.